All right, everybody, welcome back to the Cashflow Chronicles. Sorry, I just had to get the right microphone up and running. Um, so hopefully you guys are all having a good one thus far. Just going to report quickly, the market seemed to be stabilizing somewhat. The 10-year is not as crazy as it has been over the past couple days, but it is still up in terms of total amount of, I guess, just increase week over week comparatively to where we were. Trying to think what else I wanted to kind of touch base on. NextEra is still dropping like a rock. We have a few other companies that are kind of coming back a little bit, so it's nice to see that things are kind of stabilizing just a little bit. Something just came across my desk. I actually had a friend reach out to me. They had bought Pioneer Resources, or ticker symbol PXD, not too long ago, with just knowing for the fact that they probably would be in this situation, which is it looks like Exxon is nearing the opportunity to buy them out. And so they are a premier producer in the Permian. For those of you guys that don't know much about the Permian, they produce about 6 million barrels a day, almost 50% of the total oil production in the United States comes from the Permian. And so Pioneer is one of the largest landowners here. And with that, they have been focusing primarily on the Permian. It's about a 50 odd billion dollar company as it stands today. And just based off of news sources, it looks like that they will be buying, Exxon will be buying them for about $60 billion. This is the largest deal that I've seen since Occidental had bought Anadarko, which Chris and I talk about pretty frequently in the past few years. So for that, pretty impressive. Let's pull up some of these articles and see what people are kind of saying here. Wall Street Journal probably won't let us read it, but let's see what Bloomberg has to say. They might not let us read it either. Let's see. Here we go. So Exxon could seal a deal for the shale drilling pioneer in days, as reported by the Wall Street Journal. Reported Thursday night, assuming last minute talks don't hit some sort of roadblock. And this is something that has been kind of in the talks for quite some time. People have known about the fact that Exxon is doubling down and divesting in non-core assets in a lot of the world and really focusing strictly on the Permian and Guyana. And so, there was talks and rumors back in April that it was going to happen. And obviously it hasn't been done since then. But the hope is that it would be getting bought here. To look a little bit into Pioneer specifically, natural resources, let's just take a quick look specifically at how much they're kind of producing on a daily basis. So let's go to their 2Q earnings report here. Let me just pull this up. This guy. And here we go. Share. So for those of you guys that don't know much about it, let's just see. So oil growth 5% year over year. It's pretty dope. Let's just see. Largest continuous Permian acreage position. So all this good stuff. You can see all the other folks that are in here, and it cites specifically. You have Birch, ConocoPhillips, Crown Quest, Chevron, Endeavor, Fang, and Exxon as well. 75% of Q2 free cash flow returned to shareholders. They're doing relatively well. Their production, specifically oil, is 369,000 barrels a day, which is pretty impressive. And you have 711 oil equivalent 1,000 barrels a day. Low lifting costs, low lease operating expenditures. So in that respect, pretty good. Low debt, net debt comparatively to EBITDA. So in that respect, pretty good. Originally, they were focusing on getting about 372 barrels of oil per day, 1,000 barrels of oil per day. And it looks like they're kind of up to the range of 364 to 374, which is kind of the top of that range. So it's a pretty cool oil company, if that makes any good sense. Let's just see if we were to put a dollar value on this. Let's just say 60 million divided by, what is this? Let's just say it's 370, right? Because you'd get rid of, yeah. So you're paying about $160,000 per barrel of oil, which that's a lot. But if you were to talk about oil equivalent, it'd be like $80,000 per barrel of oil. So anyway, I thought it was pretty interesting to kind of report into you guys. And for those of you guys that don't know much about Exxon, they focus, and this might be the cool part to look specifically into Exxon, because they have so few. They have so few areas in which they operate now. I mean, I've worked with them as a partner briefly, but I can't go too much in depth about that. But what I can share is their investor presentation here. And you'll see that they focus pretty extensively on two different areas. They focus on the Permian, so very much where Pioneer Natural Resources are. They focus on basically this factory method, to make sure that everything is as basically as the margins as good as possible with respect to that. And then do they have anything with respect to Guyana in here? Or it doesn't look like it. So yeah, it's most of the time they have a picture here of one of the boats that they have, but most of the time they're focusing on one of two things. They're focusing on just extending the lateral length to be able to get the dollar cost per foot down, in terms of, because every time you drill a new well, there's intangible costs that are basically you can't get rid of. And so every time you spud a well, there's always going to be an underlying, say, however many millions of dollars that are going to be there. So if you're able to just spud a well and continue to drill and keep that in one well bore, as long as it's efficient, recovering more oil, then it is what it is. So the thought process is the days per 10K. That's a big piece, right? You want to get this going down and to the right. You want your well performance, your oil equivalent barrels per lateral foot to go up and to the right. And then obviously this is talking about net present value of all the wells that they're drilling, kind of going up and to the right as well. And so this is kind of what you're looking at. They're trying to get their wells between 10 and 15,000 feet. And so when you do something like this, you have this cookie cutter sort of approach, like assembly line sort of approach. You can really focus on drilling all your wells in the same length, and you have continuous acreage. You can go for those 10, 15,000 foot horizontals, unlike what some folks might be able to do if they don't have continuous acreage. Now, for those of you guys that aren't really familiar with how a lot of these lease blocks work, generally speaking, they're 640 acres, so they're a mile by a mile. And so when you have a mile by a mile, that means you have 5,280 feet going this way, 5,280 feet going that way. And so if you plan it appropriately, you can get a 5,000 foot lateral on there. It's probably not going to be perfect, because depending on surface locations and ability to drill, all depends on the environment that you're in, and the just the surface locations and the hazards, geohazards associated with it. But could get a mile by a mile, right? So you could drill a 5,000 foot lateral. So if you have several leases stacked up against each other, which is very beneficial, you can see if you like zoom in on this basin here, where Exxon, you have a very large continuous acreage position. And so you could continue to drill. Now all that matters is that you have a safe well that is able to effectively drain. And so sometimes there might be points where it actually starts to um, hinder you, right? And going an additional 500 feet or 1,000 feet might actually start hindering you. So that's what they're trying to explore in terms of trying to maximize the oil production kind of coming in. So with that, I just want to highlight specifically where we are in terms of the oil price environment, because a lot of people were very much thinking that oil was going to continue up and to the right. And so, with everything that's been kind of going on over the past, I guess you could say 2 or 3 weeks, associated with the 10-year really starting to explode, that's kind of putting a Fed put on everything once again, where we were starting to climb into the mid 90s, as of a week ago. And people are really starting to say, oh crap, just within the past month, even though we were on this climb up, we're now down 4.5%. And over the past 5 days, down over 10%. And so my thought process is this is probably where we're going to stay in this sort of area. We're going to stay in this $80 to $90 a barrel range. Before, I was kind of thinking, after the pandemic, staying in between the 70 to 90 range. And obviously we broke out of that due to what happened in Ukraine and the war that kind of impacted supply chains. And so we had that. But anyway, just thought that it was more similar to what we should be expecting with this. And so I think a lot of it has to rely on what is happening in terms of the world's growth trajectory. Are things continuing to open up, which I think China is still slow to open up. And so people are very much like thinking that it's associated with that. But you have production cuts going on in Saudi Arabia, Russia, to help put a bottom into these prices. And so it's going to play this sort of game. But all in all, you have one of two things kind of happening, which let me just double check that I'm sharing that. Yeah, so I'm sharing that. And oil production, United States. All in all, you have this massive of return of oil production in the U.S. Ongoing at the moment. Let me see here. Do we have a really recent one? That's natural gas. I just want to bring up oil specifically. That doesn't show one. But what I can show is this. So here is a good chart here that shows specifically how much oil the United States has been making. And so we are not part of OPEC, the oil producing exporting countries, but this is specifically focusing on what our max annual production output was in 2019 versus 2020. We did see a decrease because a lot of people choked back because obviously oil prices went negative temporarily in May of that year, March or May of that year. And so let's double check I'm sharing. So yeah, so where we're at today with oil production kind of coming back is we're at 12.7, almost 12.8 million barrels a day. So in terms of output, we're almost above on an annualized basis what we did in 2019. I wouldn't be surprised if we did surpass that. So keep in mind, we have been producing 12.7, 12.8 for the full year, but I'm assuming by the time we get into the second half of this year, we might get closer to 13 million, towards the end of the year. And then as we go into the run rate going into 2023 is very strong. If we're able to maintain, if not slightly raise the oil production, I wouldn't be surprised if we beat 2019 in terms of total oil production. And so the United States alone is getting close to producing about 13% of the world's oil. And I think we're actually above at the moment Saudi Arabia and Russia in terms of oil producers. So um, the fact is that we use a lot of the oil that we produce. And so with that, we do import some from Canada. We do import some from other countries as well, just based off of grade, right? So some of our refineries are meant for heavier oils. And so obviously not all the oils contain all the hydrocarbon chains that you might want in, say, tars or in, say, propane and stuff like that. So you might have to import from other countries to be able to get those sort of components. Or your refineries might be designed for other types of crudes. And so with that, you might have to import. But with that, I'll just kind of leave it there and take any sort of quick questions that people might have. And then if no questions really arise, I might call it an early day. I think I messaged Chris. I don't think he's showing up, which is fine. I know he's busy and he does his normal stream with the junkies. So let me just double check, see what he said. Why is it being weird? Oh, it keeps wanting to bring a hashtag up. Yeah, I can't make it tonight. No problem. So yeah, I'll take a second, see if there's any questions. If not, I'll probably kick it over to watching the rest of Thursday night football here with you, not with you guys, but just by myself. Actually, I was on a Discord call with one of my buddies. So let's just double check. There's no questions coming through here. I believe there is. No questions. Okay, cool. Well, there's no problem with that. Please be sure to check out Chris's Patreon if you have not already. Chris is always a really good host and is able to explain things in a manner that most people aren't. He's very well educated, very well read on a lot of these topics. And so be sure to check out Chris's Patreon in the link down below. And then if you don't mind, for doing these streams, it would be beneficial to be able to continue to do them on a more and more frequent pace. But of course, in order to do so, I need to have a little bit more skin in the game to be able to do it. I'm not asking for a lot, but just a little bit of love if you can spare an opportunity to sign up for some sort of membership or anything of the like. I'll be able to spend more time with you guys on a daily basis. At the moment, we only do these Tuesday through Thursday. And so having a little bit more skin in the game will allow us to dedicate more time and resources specifically to you guys to be able to provide as much as we can. In terms of Canadian oil companies, they're in a lot better position than they were. But I think the problem with some of those companies is some of them are very limited to their own specific basins, and they're just competing against certain, I would say, certain sort of, how do I say this? They're not diversified most of the time. They're either dealing in oil sands or they might have a little bit of offshore if you're like Suncor, but most of the time those guys just are in one basin or maybe more. I think that that's okay, but I think it all depends on what you're looking for, right? Are you looking for growth? Are you looking for dividends? And so it really just comes to really what you're expecting out of a company. And so I think it all just really is on you to kind of understand, where you think it's going to go. And in terms of midstream, I don't really know much about Canadian specific midstreams, to be very honest with you. And so I'm not going to go ahead and even try to answer that specifically. But thoughts on SCHD, I think it's another one that is dependent upon yourself. I think the yield is a little bit better. The thing that bothered me a little bit was when they did do some recycling of some stocks that were in the fund. They brought in some stocks that don't even yield anything, which I thought was interesting. I don't know if they're just trying to increase the actual growth rate of the portfolio or the ETF. And they also brought in some very questionable names, if I remember. I'm trying to remember which ones they were, but I think this goes back to the eye of the beholder as well. I mean, if you want a little bit more drip, I think that's okay. SCHD is a good one. VYM has generally been pretty good. and I think that those are good opportunities. I prefer, because I'm going to hold a lot of it, SPY, and with that SPY position, you can't get more liquid than that. And so try to write covered calls on SCHD or VOO or anything like that. It's going to be very difficult to do. You're going to be able to write monthlies, and I don't think a lot of people are really entering it for the opportunity to write covered calls. I think they're owning it for, set and forget and not really thinking about it. And specifically as SCHD, they're thinking about it for a little bit more additional dividend drip. But I think it's a good alternative if you're looking for dividends, but not anything that's too high in dividends. It's really going to sacrifice potential growth. I think SCHD is a pretty good one, and you can't get that. Canadian government will drill big time. Alberta's going rogue and promoting the shit out of oil and gas development projects. There you go. I think the problem I think, and maybe this is just because of an American investor, the problem that I see with Canadian investors is that they're so focused on Canadian companies sometimes. And I'd say that, but at the same time, I'm very focused on American companies, right? But sometimes they can't see the forest of the trees, and so they'll invest in a company in Canada just because it's Canadian, rather than investing in a superior American company. And there's some exceptions, right? Like Shopify is a great company, and I think that when you have an opportunity to buy that at a good price, you should. But there's some companies that I'm like, why would I see a lot of these Canadian guys, they stick together, always try to buy Canadian stocks. It's like, I get it. If you're like investing in a Canadian bank or something like that, where you're specifically looking towards very safe dividend yields and stuff like, I get it. But then you have people investing in like TELUS and some of these other companies that have been around, and they're not going to grow, and their dividends are probably going to get cut in the long term. It's kind of sad, right, that they're focusing specifically on say specifically Canadian companies when there's other international or American counterparts that are better. Let's see. What's my conclusion from the are you invested in NEE or NEEP? I'm invested in NEE. Personally, I think I can understand where people are kind of scared about NEE specifically because the amount of debt that they're going to be taking on between now and 2025. But I think once a lot of these projects come online, which we'll start to see projects coming online second half of this year, 2024, 2025, and through 2026, you're going to see a lot of additional renewals capacity coming online. And with that, hopefully they're going to be able to take that return on capital that they get and lower the amount of net debt that they have on the balance sheet. But I understand where people are kind of coming from. If you're afraid and you don't think it's going to make it, it could be one of those things where you wait another 6 months to a year before you really take an investment, but who knows what the price is going to be. And so you have Q3 earnings here in about 20 days for NEE. And I think with that, I think it's a company that still generates a crap ton of money. I think they can make like $8 to $9 billion in net income for the year. And I think the thing that's really just scaring people is the amount of debt that they're taking on. I think they took on additional $4 or $5 billion in the first half of this year, just in putting capital to work for investing into the renewables and wind. So, but yeah, I can understand where people are skeptical about it, but I think it's trading at a cheap discount. I think it's trading at 15, 16 price to earnings, maybe even less. Could it go down to $45? I could see that easily. I don't think it'll go below $38, but if it did, something drastically has to be misrepresented from the company, and if it is, then lawsuits will ensue. But what was I going to say? I think it should be trading because of the incumbent position that they have. should be trading at least a 20 times price to earnings multiple. And if that's the case, it should be trading at least $65 or so. So anyway, I'll end it there, and hopefully you guys come back next week on Tuesday for Cashflow Chronicles number 30. Cheers.